Good afternoon or good morning to you all, wherever you might be watching from today. Thank you for joining our Q3 Commercial Credit Trends webinar. I'm Sinead Gleason, Product Lead of Commercial Solutions here at Equifax Canada. With the holiday season now upon us, today's session promises to be very timely, giving you insights into how Canadian businesses were positioned heading into the fourth quarter. So without further ado, let's get started. On the agenda today, we'll have a look at how the Canadian commercial market performed during Q3, examine some statistical trends in Canada's transportation and warehousing sector with a presentation from Statistics Canada, and then we'll dig deeper with a panel discussion. I'll introduce our guests in more detail a little later on, but before we dive in, I'll pass things over to my colleague Sandra Shep, who will walk us through a few housekeeping items. Sandra?
Thank you, Sinead, and good afternoon, everyone. Each area within the On24 platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll try and address them throughout our session today. If there's too many questions to get through, we'll generate an FAQ document, which we'll send to you in the coming weeks. Today's presentation in English and French will be available in the coming days. As well, our session is being recorded, and you'll receive the on-demand link via email also in the coming days. Some additional features you'll notice on the bottom of your screen are an attendee chat, reactions, survey, which will pop up at the end of the webinar as well, and contact us. Feel free to check any of these out and provide your feedback. Now let's get started. Sinead, back to you.
Thanks, Sandra. So today is December 8th, and that means we are in full swing holiday mode. Thanksgiving, both the Canadian and US versions, Black Friday and Cyber Monday are all behind us now, and consumers are preparing for various end-of-year celebrations. If you're like me, you're in denial and haven't really started making much headway in those preparations yet. And if you're not like me, you're hopefully starting to get into the holiday spirit. But for the next hour, we will reflect back on the third quarter. Looking back, Hurricane Fiona struck Atlantic Canada so hard that the military were deployed into some areas. By September, the Bank of Canada issued its fifth rate hike of the year to sit at 3.25%. Our dollar fell to the lowest level in 2 years to 72 cents, and the World Bank warned of a global recession coming in 2023. So let's take a look at how the quarter played out for the Canadian commercial credit market. On the labor side, the third quarter proved to be strong in terms of the employment rate. In fact, in July, the unemployment rate sat at 4.9%. But on the flip side, the job vacancy rate continued to climb, along with the average hourly wage. So the labor market really began to get even tighter. While the income levels of Canadian businesses have been steadily rising since that drastic lockdown drop that you see there in 2020, the third quarter saw the largest single period drop since that time, according to quarterly balance sheet data from StatsCan. And in contrast, prices of industrial inputs and raw materials have been shrinking from the highs during early 2022, a sign that supply shortages and inflationary pressures may be easing. So the cash flows that have been building could possibly be leveraged to fuel investments in the future, something for lenders and suppliers to think about heading into 2023. In September, Equifax worked with Léger to conduct a survey of roughly 300 Canadian small businesses aimed at understanding the biggest challenges that they face right now, as well as the financial impact of the pandemic. So for the purposes of today's presentation, I'll just hone in on a few elements that illustrate those concerns. But before we see the results of the survey questions, I thought I'd do a quick poll of the audience to see how your answers might compare to the results that we found on our survey. Sandra, would you mind pulling up the first survey question for me, please? There we go. So if you would indulge us, if you could just take a few moments and which expenses are impacting your business the most right now. And then we'll see how that kind of compares with our Leger results. Give it another minute if you're still there. I think that it's different coming from maybe a lender perspective than if you are like an actual small business. So I'll be curious to see what you all think. Let's take a look at the polling results, and then if we can flip to that. So fuel and capital technology, interest rates are definitely of the highest, and wages. So if we flip to our Leger results, I'm just going to do that right now. Can you all see? Yes. So when asked what types of expenses are impacting your business the most, respondents indicated that products and supplies, fuel, and wages are the most expenses that are impacting their businesses the most. And fuel costs was ranked as the #1 impact, in fact. Respondents in Quebec were actually more likely to say that wages are the top expense compared to those in the rest of Canada. When asked, which concerns do you have about your ability to meet your Q4 2022 plans? Cost of goods, product availability, and staffing were what topped the list. As businesses look towards the holiday season, those concerns really highlight the issues with the supply chain that we've been seeing. The good news is that the consumer demand is no longer the same concern it was during the pandemic period. But businesses are more concerned now about their ability to meet that demand. Okay, when asked about the top non-COVID related challenge, respondents indicated that employee recruitment and retention and managing suppliers and vendors topped the list. Okay, and our last survey question was, when asked to look ahead to Q4 and what they would require from suppliers to prepare for the holiday season, more product availability was twice as mentioned as a requirement from suppliers. Second concern being more reliable distribution, again showing concerns with the current state of the supply chain. So as businesses were heading into the last quarter of the year, confidence about consumer demand was rebounding, but now there's new post-COVID related challenges that were more the issue of concern. So let's take a look at how Q3 played out with the Equifax commercial credit risk data. In Q3 of this year, small business debt levels remained fairly stable compared to last year, compared to last quarter. Sitting at an average of nearly 38,000. This is an increase versus last year of 8%. Insolvencies are down this quarter, while delinquencies are up versus Q2 at roughly 2.5%. In terms of new business openings, we still see a large decrease versus the same period last year, with just over 20% less new businesses. But a slightly positive change versus Q2, which hopefully will be the start of a more positive trend given how sluggish things have been. And then looking at credit demand this quarter, we do see the same seasonal drop like we've seen in previous years, but the medium and low risk segments are actually showing higher demand than during the pandemic, which is good news. And it's those businesses that are fairly well established that are seeking this credit. Businesses aged 7 to 24 months and the 60-month plus segments are the ones that are looking for new credit as compared to the same quarter last year. On this next slide, we're looking at credit supply within the financial trade segment. So again, these are the credit products issued by financial institutions such as loans, lines of credit, and credit cards. You can really see a burst in growth within that 7 to 24 month aged businesses cohort this past year, but it has settled down in the latest quarter. And as we saw last quarter, the higher risk segments are shrinking in terms of the landscape of new trade openings. This shift is because of the improvement in credit scores due to lower delinquencies. And on the supplier side, so these are those supplier issued accounts. New trade activity has stabilized to around the pre-pandemic levels. And this, like we saw with the FI trades, the credit scores are improving in this segment as well. This slide illustrates the regional differences of the new trade openings. So on the left side of the screen are the financial trades, and industry or supplier trades are on the right. So for FI trades, Montreal reported a continued positive trajectory with only a slight slowing this quarter. And in contrast, Toronto reports a very strong increase in supplier trades this quarter. The current economic environment continues to impact the number of new businesses that are willing to open right now. As we see lower levels of new business openings compared to the third quarter than in previous years. Not entirely unsurprising, given so many factors like supply chain challenges, rising wages, low unemployment rates, increased interest rates, and even rising real estate prices. But there is a bit of growth within Alberta this quarter when we look at the major cities. Nationally, however, things do continue to be a bit sluggish on this front. On this next slide, we compare the delinquency rates of financial trades to the supplier trades. In the latest quarter, delinquency rates are on the rise slightly versus Q2. However, they're still well below the levels we saw prior to the pandemic. It is notable, however, that the early delinquency rates, so those 30-day delinquencies, are starting to show an uptick comparatively. Something lenders are really going to want to keep their eyes on heading into next year. And when we break down the delinquency rates by industry, this quarter's presentation is kind of a sea of red. So we're now seeing increases clear across the board with double-digit year-over-year increases in nearly every industry and every quarter, and quarter-over-quarter increases as well. And then finally, when we look at the bankruptcy rates in Q3, it's tempting to be shocked by that percentage increase that we see when comparing to last year. But really what we're seeing is a return to normalized levels of bankruptcy rates nationally, and we're still well below what we saw in 2019. And I will just kind of skip over the regional view. This is just a regional breakdown of those bankruptcies. Okay, so let's just recap the trends that we saw so that you can be prepared as you're heading into 2023. Business rebounding, but not so much about their ability to meet that demand, with concerns over product availability and other supply chain issues. New businesses have remained flat this quarter, continuing that trend of caution around starting a new venture. But of the established businesses, credit demand has grown by 6% since Q3 of last year. Delinquencies are on the rise, and this is true across every single industry. Bankruptcies are also up from 2021 levels, suggesting that businesses are facing the pressure of rising rates and tighter borrowing criteria, but still sitting well below 2019. And lastly, firms that opened like during the pandemic, so that 7 to 24 month ago period, they reported the highest growth in credit inquiries during Q3. While the share of high-risk borrowers inquiring and opening new trade lines is falling. And so with that, we'll dig a little bit deeper now into Canada's supply chain and transportation industry. We do have a fantastic panel of experts joining the discussion who all bring different perspectives and insights. Joining me today are Lawrence McCowan, Chief of Analysis Transportation Statistics at StatsCan. He will be taking us through statistical trends in Canada's transportation and warehousing sector. Dionysia Kourouklis, Director of Treasury and Financing at TFI International, and our very own Jeff Jones, VP of Operations at Ansonia, which, as you might know, is an Equifax company. I'll let each of you individually introduce yourselves and tell everyone a little bit about you and your organization. So perhaps let's start in reverse order. Jeff, if you could tell us about yourself and your organization.
Absolutely. And thanks for letting me be here today. Jeff Jones, and I have been actually in the transportation space for a little over 30 years now. So Ansonia is a company who has prided itself on really having the largest set of transportation-related data that there is in the market space today. And what we're seeing is that we are able to pull in by mode, whether it be truckload, LTL, third-party logistics companies, as well as we're pulling in data from factoring companies as well. So look forward to sharing some insights to you later on, and I'll turn it over to the next person.
Thanks, Jeff, and thank you, Sinead, for letting me speak today, and a little bit about TFI. So I'm Dionysia Kourouklis. I'm the Director of Treasury and Financing here at TFI International. I've been with the company close to 5 years. I've been involved in a lot of projects, from ERP integrations, a lot of M&A activity. TFI International is one of the largest transportation companies in North America, the biggest one in Canada. We operate in 5 segments, 6 if you count specialized truckload. So we have Canadian, less than truckload, US LTL, Canadian and US truckload. We have logistics and specialized truckload. So we have a very diversified portfolio, and I'll talk a little bit about that later on. But it's really made us a key player into the transportation space.
Great, thank you very much.
Forward to sharing that with you.
Thank you. And Larry, can you introduce yourself and your organization? And then from there, we can go right into your presentation.
Okay, certainly. Thanks very much for the introduction, Sinead. As she mentioned, I'm Larry McEwen, responsible for travel and transport analysis at Statistics Canada. Some of you may be familiar with our monthly products, as we put out monthly railway car loadings, urban transit, civil aviation statistics, international travel and border crossings, and so on. And my bio is online if anyone wants to look at it. I've been with Stats Canada and elsewhere for a number of years, working in the transportation-related areas. Just a little bit about Statistics Canada. I think most people are familiar with the agency, from our monthly labor force survey, which produces the unemployment rate, our consumer price index, which puts out the year-over-year inflation, which I think people are really focused on these days, and our output, our gross domestic product estimates. And I'm going to talk about all 3 today during the presentation. What people may be less well known about Statistics Canada is that we don't report to a minister. We report through a minister. We're kind of independent, and we follow a mandate. We have a parliamentary appropriation of money to conduct the census and other programs. And our mandate is to inform Canadians, individuals, businesses, as well as government, on the state of the economy and our society. And so a forum like this is exactly what we should be doing, is out there and providing information to all Canadians. So what I'm going to do today, let me just share my screen. Yeah, so is that coming up, Sinead?
I'm not seeing it on my screen. Perhaps what I can do is share from mine.
Yeah, you're going to have to do that, because I've tried it now 2 or 3 times before.
Sure. Let me try that
one more time.
How's that? Can everyone see this?
I'm still seeing the supply chain in Canada panel.
Okay, I wonder if it'll take a moment. View tab. I see thumbs up. Okay. So on our screen, Larry, we are seeing the panel, but on the audience can see the slides. Okay, so right now we have the table of contents up. Do you want to view it from your computer
Sorry,
screen?
that's not my presentation.
Okay. Let's see. I'm going to try and get...
It's called Equifax Q3 Small Business Final.
Yep. Let me go here. Nothing like on the fly, doing it on the fly. So hold on, just bear with me. And I'll try and get our... I think I lost myself, but I'm back now. Can everyone hear me?
Yeah, we are back live. Thanks everyone for your patience.
Yeah. Okay, so does the audience see the slide? Statistical trends in Canada's transportation and warehousing sector?
Yes.
Okay, so
I got it.
okay, so what I thought I would do is provide an overview of trends in transportation and warehousing and provide some national and industry-wide benchmark information which can help provide a context for which you can situate your specific business and local conditions in terms of assessing credit. And in terms of the outline, after the unprecedented shuttering of the economy in 2020, the supply chains were slow to recover with input problems, port congestion, container imbalances, as well as weather events, BC flooding, whatnot. I'm going to focus on three trends. I'm going to start with providing a context and some definitions. The three trends are oh, there they are. Okay. Employment and job vacancies. Then we'll go to output and economic output and obstacles. And then finally, we'll look at producer and consumer prices. Next slide, please. Just for some context, this is an economic time series of retail trade. The numerator is online sales as a proportion of the denominator, which is total retail sales. And you can see it starts in January 2016 at about 2.3%. And as any time series in the economy has, it's got a long-term trend, which is upward. And then it's got the business cycle, which is hard to discern here because the numerator and denominator are changing at the same time. The third element of a time series would be seasonality, and you can clearly see the spike every year between about Black Friday and Boxing Day, when there's a lot of online sales. Then in the period of the spring of 2020, you see kind of what we call in economics is a one-time shock. And online sales went up to about more than 10% of retail trade. That's because the denominator, retail trade, shrank as people were not buying cars and home furnishing because stores were closed. And that those things that people were buying, they were doing more online. Next slide, please. When we measure output at Statistics Canada, we measure it by industry. And this just illustrates how we do it. We use something called the North American Industry Classification System, which covers sectors 11, agriculture, to 91, government services, and everything in between. And I'm going to focus on today is those businesses which we assign to the transportation and warehousing sector, 4849. And it consists of about a dozen industries. Some of them are primarily passenger, like the first one, 481, which is air, but it's a little bit of air cargo because of growth lately. And then you have rail, which is primarily freight, and there's about 12 of them. And the ones I'd like to focus on today would be trucking, as well as warehousing and storage, and the entire sector itself. So the slides that follow will kind of be focusing on those industries. For those of you looking at something like 488, freight and transportation support activities for transportation, that would be both passenger, something like NAV Canada, and freight, that would be freight forwarders and custom brokers and 3PL logistics as well. And can we go to the next slide, please? This just indicates how we measure labor, both on the supply and demand side at Stats Canada. So most of you are familiar with the labor force survey on the supply side. That's a monthly survey of individuals. It goes to households. And the unemployment rate was about 5.1% in November. So it's still very tight, the labor market. On the demand side, we have a couple of instruments. We have the Survey of Employment, Payroll, and Hours, which is a monthly indicator of. We get a lot of information from payroll remittances, and so we can get information on wages as well as hours and just the number of people employed. And then we also have something called the Job Vacancy Survey as well. And so can we go to the next slide, please? Just quickly, we're going to look at some trends in employment and job vacancies. And the first slide in this section, go ahead. That indicates there's about 800,000 jobs in transportation and warehousing, sector 4849. About 200,000 of those jobs are in trucking, and another 75,000 in warehousing and storage, or NAICS 493, and then about 500,000 in the other industries such as rail, air, urban transit, and charter bus, and so on. As you can see from the graph, that there was about 100,000 jobs lost in this sector because of COVID in the spring of 2020. It's not a lot. If we go to the next graph, you can see that the red line is transportation and warehousing, and it didn't go down as far as the economy in terms of job loss. That's because a lot of companies like airlines and railways and I would think public transit companies as well took advantage of some of the wage subsidies programs. So I think a lot of those companies reduced the hours, but not the number of employers. And it didn't go down as far as the economy in terms of jobs. Let's go to the next slide, please. Okay, so this is a slide of job vacancies in the transportation and warehousing sector. There's about 50,000 vacancies at the end of the second quarter. So this is in June of 2022, and the job vacancy rate was about the same as the economy. It's about 5.9%. So that's kind of tight. And you can see there's a gap there in the second quarter of 2020 when we had to suspend the survey. We were kind of closed down like other businesses as well. We had to reduce some of our activity. Next slide, please. This is the same survey of jobs that are vacant in warehousing and storage. As you can see that there isn't that many jobs overall, and that the job vacancy rate in warehousing and storage is lower than the overall economy. When I look at this, the first thing I'm thinking is warehousing and storage. That would be a sector that would include things like fulfillment centers. That's a sector where job loss, the pressure on labor shortage really isn't there because there's been a lot of automation, such as robotics in that industry. Next slide, please. If we can contrast that with the trucking industry, where at the end of June, there was 20,000 jobs that were vacant. And that job vacancy rate was almost 1 in 10. So, and this is just jobs in the for-hire trucking industry. So that excludes all the private trucking, that activity, and jobs that belong to other industries. You can see a fleet of Canadian Tire trucks or Tim Horton trucks. That's private trucking belonging to retail trade, for example. So, if you go to the next slide, please. With that kind of vacancy in trucking, we see upward pressure on the wage rates, and that makes sense. That if there's a cyclical problem, that the economy is kind of going full tilt now, and there's a shortage of truck drivers, for example, you would see upward pressure on the wages. Next slide, please. But this is telling me a different story. It's saying more than one half, 50% of those 20,000 jobs have been vacant for 3 or more months. So to me, this is an indication of more of a structural than a cyclical problem. Excuse me, a sort of a long-term problem. And when you see this, you can think of what long-term labor problem. What is the government doing? Well, the target for immigration is up to 500,000 a year, I think, for the next 5 years, because this kind of demographic challenge that we're facing in the labor market. And I'm going to walk you through an example on the next slide. And my apologies, it's a very busy slide, but on the left-hand axis, you see population change, and this is over 3 years, from July 2019 to July 2022. On the left-hand or the right-hand axis is labor force participation, and what you have along the horizontal axis is the age groups. So basically, going from right to left, you have baby boom, baby bust, and the echo, the children of the baby boomers. So if we just go to the far right bar, what that's telling you is 500,000 people in the 3 years, just in the last 3 years, transitioned into the 70-plus age group. And of course, as you get older, your labor force participation rate goes down. So I've got 2 check marks on the right side of the slide. The first one indicates that if people didn't age, if people stayed the same age over those 3 years, if the population didn't age, in other words, there would be an additional 350,000 people in the labor market. Of course, people don't stay the same age, they do age. And so how can, just by the fact that people are aging, we're losing, the labor market is shrinking. And the second point is, well, we can kind of mitigate that if the participation rate of older age groups increases. However, and what I say here is, but what we're seeing is a great resignation. A lot of people are getting called back to the office. They're kind of throwing in the towel, for example, saying, well, I'm going to retire at this point. So there's no indication that participation rates are increasing. So let's go to the next section, please. So we'll take a quick look at economic output and obstacles. The first slide, it's basically, the black line is we measure gross domestic product in different ways at Stats Canada. One of them is by adding the value added of each industry on a monthly basis. And this is what we call our GDP, monthly GDP by industry. So I've indexed everything to to January 2018 equal to 100. You can see that output in transportation and warehousing, which is the red line, dropped far below that of the economy in the COVID onset of COVID in the spring of 2020. And it's yet to recover fully the same way as either goods or service producing industries have. So I'd like you to keep an eye on the red line. We'll go to the next graph. And that red line, I said that transportation and warehousing consists of a number of industries. So I've taken those industries and I put them into freight, predominantly freight, and that's in the light gray, or the gray line. So that would be trucking, rail, and marine. And we can see that it recovered quicker, and it didn't fall as fast as the sector. Contrast that with the blue line, and that's the passenger industries. So we're talking air, urban transit, intercity bus, charter and sightseeing, and so on and so forth. It dropped almost 20% of where it was pre-pandemic, and it's still not back. Output in those industries is about 2/3 of where it was. And on the top is warehousing and storage, which I pointed out at the beginning, saying, okay, this thing kind of took a little dip, but then it's taken off since. I think I put courier in there as well. So that's courier, warehousing and storage. And that sector, those industries have really grown in the post-pandemic era. Next slide, please. And this is a graph of, this is another GDP graph. This is quarterly though, and it's basically inventories. And you can see that in the years, the negative inventories in the 4 quarters of 2020 were when we were shutting stores and we were shutting factories, that any sales that were taking place, a lot of it was eating into inventory. So we had negative inventories. And then we started to kind of try and rebalance things last year, and we ran into supply chain problems. And now, though, in the third quarter that just came out, we see almost a $60 billion inventory in manufacturing, wholesale, and retail. And I'm looking at that $16.7 billion retail inventory, and I'm thinking, what is this signaling to us? And so my national account colleagues have said about half of that is motor vehicles. This time last year it was hard to get a motor vehicle, right? Because of, they just weren't, the inventory wasn't there. Another large part of that retail inventory is home furnishings, as well as building material. I mean, there was a big run on building material this time last year. So my concern with this is that now that supply chains have rebalanced and we're starting to get to deliveries and we're accumulating inventory, but what's going to happen to the consumer with another rate increase in interest rates? Are those going to are we building up inventories, and are we going to have to be like laying people off because we've got too much inventory? I don't know. It's a question for other people. And next slide, please. Okay, this is just, we do a quarterly business conditions survey, and it goes across the economy. And I've got, in the red, I've got transportation and warehousing, and I've got all industries in the blue. As you can see, that labor shortages were not identified by transportation and warehousing companies as something that was an obstacle in the fourth quarter. As I indicated previously, it's more of a long-term challenge. But what they did, half of the companies did identify were transportation costs as a challenge. And the bar at the bottom, inflation was cited by almost 60% of all companies across the economy as the biggest challenge. So let's go to the next section, which is on prices, and we'll take a quick look. And the first graph in this section is we measure producer prices as well as consumer prices. So what does it cost to produce a given good or service? Here I've taken 3 producer prices of trucking, rail, and courier, and I've set them all equal to 100 in January of 2018. The example here is if the red line is courier, so something that costs $10 to send by courier in June, or say May or June of 2020, 2 years later is costing $14 to send. And you can see that all of freight rates, I'm going to call them freight rates, have gone up. The rail, mainly what's driving the rail increase is what's called intermodal. So this price pressure, next slide please, is being passed on into consumer prices. And we all heard about the inflation rate. And this is a graph where I put the inflation rate, all items CPI, Consumer Price Index, and I've taken out some components of it, transportation, as well as air component and gasoline. The example here is air. So if it cost you, in September of 2020, it cost you $1,000 and $1,030 to fly from Ottawa to Vancouver. That same flight in September of 2022 is going to cost almost $1,500. And the inflation rate is still 6.9%. So next slide, please. And this is telling me that the pressure, upward pressure on prices is still there. This I just saw recently that both Canada Post and FedEx are putting a 40% surcharge, a fuel surcharge on domestic packages. So the example I gave earlier, if it costs you $14 rather than $10 just 2 years ago to send a package, well, you're going to get slapped with a 40% surcharge on that as well. And I think that's one more slide, and I think, yeah, thank you. Sorry about the technical challenge here. I wanted to mention my co-presenter, my co-author, I guess, from the Canadian Centre on Labour Information, André Bonneuil. Any questions, I'd be happy to answer. And I'm going to leave it there because I know we have some other panelists and we're squeezed for time.
Great. Thank you very much, Larry.
You're welcome.
So I'd like to maybe now turn over to Dionysia and Jeff to get their take on how all these various factors have been impacting Canadian businesses. Perhaps we'll start with Dionysia. So how did TFI circumvent the supply chain issues following the pandemic? I'm not sure if, can everyone hear?
Can you hear me now?
Yes, we can hear you now. Sorry about that.
A good old you're on mute problem. Sorry about that. Thank you, Sinead, for the question, and thank you, Larry, for the statistics. It's very insightful. So to jump on your question, right on your question there, Sinead, I want to first, let's take a step back and, appreciate what our truck drivers are doing for the economy every day and every mile. I'm so proud to work for this industry. I think it was really evident during the pandemic how important the transportation industry is. So having said that, we did run into supply chain issues. We all know the microchip issue that a lot of companies and tech companies were facing. Well, we were facing the same because there's a lot of microchips that go into a truck. There's a lot of technology behind a truck. It's not just wheels and a cabin. There's a lot of safety features for truck drivers, so that requires microchips. So we were faced with a problem. Our two core, our two core items, if I should put it like that, it's our truck drivers and our trucks. And right now we had the truck drivers, but we didn't have the trucks. Even as I'm speaking today, out of 700 tractors that we've ordered, we've only received 160. So there's about 600 tractors that we're still waiting for. And that was a huge issue for us because, we didn't have what we needed to continue our business. Luckily, the silver lining in all that is that it actually played somewhat in our favor. And the reason for that is that we significantly saw our CapEx spent drop. So we were ready to spend a certain amount on CapEx per year, and we only pay the trucks when they are delivered to us. So right now we found ourselves with inflated or increased free cash flow. So we had to decide, what are we going to do with that extra money that we're supposed to go to the fleet, but now we have to wait. So we decided to put our money to good use, and we paid down debt. We lowered our debt to EBITDA ratio to 1, which is exceptional for a transportation company. This means a strong balance sheet for us, and it gives us a lot of dry powder for a major opportunity. So it gave us a competitive edge to say, well, we can't spend our money where we want to, but maybe we're going to put our money to good use. Money to good use for us also means M&A action. So, Mr. Bédard, our CEO, is heavily involved in M&A. We do from, small tuck-ins to larger acquisitions. Like in 2021, we acquired UPS Ground Freight. In 2020, we acquired DLS Worldwide, which was rebranded to T-Force Worldwide. And typically we do around 250 to 350 million dollars per year in M&A. And it also that increased cash flow allowed us to maintain our dividend strategy for our shareholders. So all that to say is that, the supply chain prevented us from overstaffing, overbuilding, and essentially overbilling our customers. So it really gave us a competitive edge on that front. The second thing that helped us, again, silver lining in all this, was the diversification of our business. I mentioned that in my intro. We operate in 5 different segments. And what that did is that it allowed us to recycle some of our fleet to other divisions that needed it. So we took, for example, the divisions that, transport cement and, aluminum and construction materials that were completely to the floor during the pandemic because there was no construction going on. And we took those trucks and we said, well, how can we put them to good use, and maybe other divisions, other segments need them. So we were internally able to rotate our fleet to meet the demand and make sure our assets are put to good use. And again, it allowed us not to overbill the customers because we already had the trucks in our possession.
Well, that's great news. Jeff, how about in terms of the Ansonia data, what are the trade volume trends telling us as it relates to all of this? And what might that mean for lenders as they head into 2023?
Yeah, well, I think there's several things that are going on. Obviously, when we saw the pandemic hit, the supply chain world, spiked out. Transportation became a prime focus. And as we're starting to look now, and we start comparing in our indexes, looking at last year to this year and comparing things, what we're actually seeing now is where for the most part, like in the LTL world and the truckload world, those areas seem to be staying somewhat on a slight decrease in volumes that are coming in. But when you start looking at areas like third-party logistics companies and factoring companies who are purchasing receivables from the smaller carriers that are out there, we're seeing those actually showing flat over last year in the index or decreasing. So what it's kind of helping us understand from one side of it is a lot of this business that companies were working with their carriers last year were able to negotiate some solid pricing programs, building out agreements with them. And now a lot of that is staying on that contracted carrier side. And then where you're seeing a little bit more of the faltering on the volumes is going to fall more into those smaller carriers that are out there that work primarily with third-party logistics businesses or factoring companies. The other side that you'll see, too, from a lender is keeping in mind that as the volumes from month to month begin to drop, what you'll also experience is that initial increase in your past due receivables as a percentage, because when you're not putting as much in that current bucket, then the older stuff that's aging out is going to seem like a higher percentage. So keeping that in mind as you start to benchmark compared to last year, previous months, right, and looking at what that percentage is that's rolling on beyond that. So,
right. Yep. And then maybe I'll just go back to Dionisia again. And in terms of the impacts of inflation, are you able to comment on, what was the impact on TFI for 2022? And how could that maybe have affected the economy overall?
Sure. Am I on mute? Yes, I am. Okay. Sure. Yeah, inflation plus what it meant is, and we spoke about it, Larry spoke about it a little bit before, was it was really the salaries of the drivers. Okay. So if we take a step back and we try to understand the life of a truck driver, it's a hard life. It's you're away from your family for long periods of time. You're alone. So there's a lot of solitude. And you're eating at local dinners, you're stopping at rest areas where during COVID, these areas and local diners, they were exposed to COVID, and some of them got scared and actually left the industry and never came back. So the driver shortage for TFI and other transportation companies was really pervasive. It was huge, and it was a major hurdle to overcome. And one of the things that we did, and of course we understand that, because we're in transportation, then if we're paying higher salaries to truck drivers, at the end of the day, it's the consumer that pays for that increase. So it has a direct impact to inflation. And what that meant for us is that now we had to pay sign-in bonuses. Now we had to pay referral bonuses. We had to pay, third-party companies to find us these truck drivers. One of the things that we did is, we heavily negotiated with our unions. So we're trying to really make those truck drivers happy. And 95% of our truck drivers are really on the top pay scale of all truck drivers in the industry. So, again, it gives us a competitive edge versus other companies, but we really try to pay at the top scale of our drivers. So like I said, inflation was a direct impact of that driver shortage. And, it's not just a driver shortage. I think we all have heard in the news how other companies in other industries are also faced with this demographic problem, because like Larry pointed out, people are aging and they're not coming back to the market. So I'm curious to see how, the government maybe needs to step in and have some concrete solutions to this problem.
Some training programs or incentives or whatever that might be. Yeah, that's a good point. We did get a question in the chat. And so, Larry, there's an audience member wondering if the data about the shipping rates going up is valid across Canada, or is it region specific? Are you able to comment on that if you can come off mute?
That's national level data.
Okay, so that's clear across the country.
Yeah, and and I have to go. I can take a look. I don't know whether there's regional. Like on the consumer side, the CPI, there's provincial and even sub-provincial estimates. But on the producer side, I don't know off the top whether it goes down. It does break down into segments. So in trucking, there would be general freight, specialized freight, local movement. In rail, it's by commodities, and in courier, it's in courier, local messenger. So I just gave you the kind of high level national trends.
Great. Thank you very much.
You're welcome.
Okay. Well, we are almost at time. So with that, I think I would like to wrap up. And panelists, I want to thank you very much on behalf of Equifax Canada for participating today, and even with our technical glitches. Thank you for hanging in there. This has certainly been extremely informative for me personally around this topic, and I'm sure it has been for our audience as well. And to all of you joining us today, thank you for your time and active participation. I hope you've learned something that you can carry into the new year to help your business and strategic plans. This is our final webinar for the year, so I wish you all a healthy and happy holiday season, and hope that you get to enjoy some downtime to recharge your batteries and start 2023 off strong. Before you log out, please take an opportunity to fill out the survey, and do feel free to share any thoughts about today's webinar, as well as any recommendations that you might have for future events. We'd be very interested to hear from you. If you would like to share this session with a friend or a colleague, a link to the recording will be sent out within the next 24 hours. As always, a special thanks to our webinar production team, Stephen, Sandra, Robin, Bala, Swarnama, Robert, and his entire team for helping pull this all together. Thanks again for joining us today, and I wish you all a happy holiday season. We'll see you next time.
Thank you.